Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Now, before we get started, here are some key concepts to think about. APR stands for annual percentage rate. It attempts to factor in upfront costs to deliver a true cost of financing, which is typically higher than the interest rate on your mortgage or the note rate on your mortgage that your mortgage broker probably quotes you. APR relies on human input and variables that can be manipulated to a certain extent. Thus, it's an imperfect measurement. A slightly lower APR from one lender may not necessarily be a better deal. Some upfront costs associated with a mortgage are considered prepaid finance charges in that they are only paid in order to obtain a mortgage and not tied to a tangible service. You can see this on your loan estimate, or LE, by looking on the right-hand side of the fee, and if the fee is designated by the lender as a prepaid finance charge, it will have a PFC next to it. So here's an example. Homeowners insurance is a tangible product that could and should be paid regardless of the presence of a mortgage. Therefore, it is not a prepaid finance charge. A loan processing fee, on the other hand, is only something you'll pay if you're getting a loan and therefore is a prepaid finance charge. Prepaid finance charges, or PFCs, are neither good nor bad. They are not scandalous or uncommon. A loan without them isn't necessarily a better deal than a loan that has a ton of them. Even if you're told you're not paying PFCs, most of them will still need to be paid by someone. There's no such thing as a free loan. Typically, this involves the lender offering a higher interest rate and then paying the PFCs for you. In that example, you're simply financing the PFCs by paying higher interest rate over time. Again, that's not neither good nor bad. It's just a choice between paying more up front or more over time. PFCs are most notable because they determine the annual percentage rate, or APR. Lenders are required by law to disclose the APR. This is a good idea in concept, but it's not so simple in practice. Regulators try to level the playing field by forcing lenders to give consumers an idea of what the true cost of financing will be. Indeed, the notion of quoting mortgage rates in terms of a note rates and upfront lender-related costs is a fantastic, and it's ideal. But unfortunately, regulators leave it up to the lenders to do their own APR calculations. While most lenders do things the same way, others do things differently in order to quote a lower APR than their competitors. Some lenders are simply more conservative of what they define as a PFC because they want to avoid that scrutiny. Those lenders may have higher APR quotes than others, even if a single upfront costs are exactly the same. It's crazy, I know, and very confusing. So here's the bottom line. APR is not necessarily apples to apples. You shouldn't blindly trust one lender's APR over another. As tedious as it may be, the best way to compare quotes is to see what the upfront cost assumptions are line by line, and you can do this by asking for a loan estimate from each lender and compare them side by side. So I hope this helps you better understand what an APR is and that it's not the only factor you should consider when shopping for lenders. And if you'd like to know more, reach out to me. I certainly would love to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. So until next time, take care and stay safe.